Every second, $1.4 billion moves into index funds. Almost none of it asks what anything is worth. The market still moves, but movement is no longer judgment.
In 2026, passive investing controls more than half of all equity assets in the United States. For the first time in the history of modern markets, most of the money is no longer deciding anything. It is simply following. This is not a story about ETFs. This is not a warning about one fund, one sector, or one bad bet. This is about what happens when a system designed to measure value stops measuring anything at all. Price was supposed to transmit reality. It no longer does.
To understand what is breaking, you need to understand what price actually was. Not a number, a conflict. Every time a stock was bought and sold, two people disagreed. One believed the price was too low, the other believed it was too high. That disagreement, repeated billions of times, produced something no single person could calculate. A signal, risk, value, scarcity, expectation, all compressed into one number, updated in real time. The system was slow, it was inefficient, it was expensive. Analysts spent thousands of hours researching companies most people had never heard of. Fund managers placed bets that destroyed careers when they were wrong. But that inefficiency had a function, because disagreement creates resilience.
Markets survived not because everyone agreed, but because someone was always willing to disagree with the crowd. That contrarian, that skeptic, that short seller, they were the system's immune response. When price drifted too far from reality, they pulled it back. Think about what that means at scale. Millions of investors, thousands of institutions, all running the same calculation and producing collectively a price signal that no individual could manufacture alone. The market was not smart, it was not fair, it was not even accurate most of the time, but it was honest about one thing. It was always trying to figure out what something was worth. In 1975, John Bogle launched the first index fund. The idea was simple. Most active managers underperform the market over time. Stop trying to beat it, just track it. It was designed to reduce cost. It was never designed to replace judgment, only to follow it. The critical assumption buried inside that logic was this: someone else would always be doing the judging. Passive investors could free ride on the price signals produced by active ones. The system would remain honest because enough participants would keep it honest. That assumption held for decades. It is no longer holding.
For decades, index funds existed alongside active management, a minority of capital, a passenger in the system. Then, something shifted. After 2008, trust in active managers collapsed. Fee-conscious investors moved to passive funds by the trillions. By 2019, passive assets matched active for the first time. By 2024, passive had taken the lead. And with that shift, the question the market asked every day quietly changed. It stopped asking, "What is this worth?" It started asking, "Where is the money flowing?" This is the transition from price discovery to flow discovery. And it matters because of what happens next. Rising prices attracted more passive inflows. More inflows pushed prices higher. Higher prices attracted even more inflows. The system stopped measuring value. It started amplifying itself. Today, the top 7 companies in the S&P 500, Apple, Microsoft, Nvidia, Amazon, Alphabet, Meta, Tesla, represent 35% of the entire index. Not because 35% of analysts decided they were worth 35%, because passive flows, by design,
buy everything in proportion to size. The bigger you are, the more you get bought. The more you get bought, the bigger you become. Price is no longer a judgment, it is a feedback loop. In 2023, Michael Burry disclosed a short position against the S&P 500 and NASDAQ. Burry is not a prophet. He is a signal detector. In 2008, he was not predicting the future. He was reading a structure that had already broken and waiting for reality to catch up. When Burry shorts the index, the question is not whether he is right. The question is, what anomaly is he detecting? The answer is the same one this episode is built on. The market is no longer pricing assets. It is pricing allocation.
Every functioning market requires a specific type of participant. Not the buyer, not the seller. The contrarian. The investor who looks at a falling price and says, "This has gone too far. I am buying." That single act, repeated across thousands of investors, is what creates a floor. It is what makes a crash recoverable. Active investors were inefficient. They were expensive, often wrong, and frequently arrogant. But they performed one critical function. They were willing to be wrong alone, to stand against the flow, to disagree with the crowd. Passive systems cannot do this. They have no opinion. They can only mirror allocation. In March 2020, for a brief moment, the mirror stopped matching reality. As markets collapsed, ETF prices fell faster than the underlying assets they tracked. A fund that was supposed to represent a basket of bonds was trading at a discount to the bonds themselves. The system that was supposed to track reality briefly became detached from it. The Federal Reserve intervened within days. The crack sealed. But the mechanism was visible. Under stress, passive systems do not stabilize, they amplify. The Fed bought time. It did not fix the structure. Now consider what happens in the next liquidity crisis, one large enough or fast enough that no central bank intervention arrives in time. Passive investors do not ask whether the price is right, they redeem. And when they redeem, every stock in the index falls equally, the overvalued and the undervalued, the strong and the weak, because the system never distinguished between them. There are no buyers waiting at the bottom, because no one was ever deciding what the bottom was. This is not a prediction of collapse. It is a structural observation. A market without price discovery cannot define its own stress. It can only transmit it. Here is what most financial commentary will not say directly. The passive investing revolution was not a mistake. For the average investor, it was rational. Lower fees, better average returns, less emotional decision-making. But systems do not fail because of individual mistakes. They fail because individually rational decisions produce collectively irrational structures. Every investor who moved to passive investing made the right choice for themselves. And together, they built a market that no longer knows what anything is worth. This is not a conspiracy. There is no villain. This is a structural drift, the same drift that made Evergrande's debt look safe, that made FTX's balance sheet look solvent, that made Terra Luna look stable. In every case, price stopped transmitting risk. And in every case, the system functioned perfectly, right up until the moment it did not. Terra Luna. The price of trust collapsed overnight. FTX, the price of risk, was never real. Evergrande, the price of debt, was a political fiction. And now, the price of everything. Not one asset, not one sector, not one bad actor. The mechanism itself. Price was never just a number. It was civilization's coordination system. The way markets told builders what to build, lenders what to lend, and investors where the danger was. When coordination fails, collapse does not begin with panic. It begins with silence. The silence of millions of investors moving together without anyone asking why. The index is not next because it is weak. It is next because it no longer decides anything. Different systems, same failure. The moment price stops transmitting reality, collapse becomes invisible until it becomes unavoidable.